Marifa.
Bismillahir Rahmanir Rahim. In this lesson, let us discuss about Salam and Istisna. Salam and Istisna are basically sale contracts, but these contracts are in a way exceptions to basic rules which are applied in an Islamic sale contract. The basic principle in an Islamic sale contract is that when the seller is selling an asset, that asset needs to exist for the sale contract to be valid. But in these two contracts, both in Salam and Istisna, when the sale contract is entered into, the asset is not in existence. So therefore, this is an exception to the basic rule of sale contract in Islam. Let us start with Salam. What is Salam? Salam is basically purchase of commodity for deferred delivery in exchange of immediate payment. So what it means is that all the payment has to be made in advance and the delivery needs to be deferred. In such a structure of a sale contract, that structure is called as a Salam. So one of the main principles is with relation to the subject matter. The subject matter can be divided into two components. One is the object and the other is price. Now let us discuss about object. Object meaning the underlying asset, which is the subject matter of the sale contract of Salam. Now the object should be goods which can be weighed, which can be measured, or which can be counted. The specification have to be very clearly agreed upon between both the parties, so that in case if that specific good is not delivered by the seller to the purchaser, then the purchaser can cancel the contract. So the idea being that the object in the sale contract needs to be very clearly defined. The second important thing is that this object, which becomes the subject matter of the sale contract, should be easily available at a place of delivery. What it means is that the parties should not enter into a Salam contract for very specific and unique goods, to be delivered. The goods which are to be delivered needs to be easily available. So the idea is that in case if the seller fails to deliver those goods in time, then the seller should have the option to go and purchase similar goods from the market and deliver it to the purchaser. So one important principle in Salam is that the object needs to be in such a way that these goods should be easily available at the place of delivery, right? So in case if the seller fails to deliver them, he should have the option to purchase it and deliver it. The second is in terms of price. The price again has to be known very clearly and all the price needs to be paid in advance. So this is a very important principle in Salam. So for example, if the parties have agreed the sale price as $100, so that $100 immediately needs to be paid by the purchaser to the seller when they enter into a Salam contract. So the price needs to be clearly agreed upon and it needs to be paid upfront, right? So this is another important principle in a Salam contract. Now, in terms of the conclusion of the contract, the same principle which is applied to the Islamic sale contract also applies here, that there has to be a proper offer and this offer needs to be properly accepted by the purchaser. And another important point in Salam is with reference to delivery of subject matter. So it has to be clearly agreed upon, the date, the time when the subject matter needs to be delivered by the seller to the purchaser, It is very important because in case, for example, if there is a delay in terms of the delivery, there are two options. One is the purchaser can wait until the seller delivers the goods, or the other is the purchaser cancels the contract and obliges the seller to purchase the similar commodities from the market and supply to the purchaser. So there are two options available to the purchaser. But the option which is not available to the purchaser is that the purchaser cannot cancel the Salam contract in case of delay and also charge a late payment fee and keep the late payment fee with itself. Now let us quickly understand the structure of Salam. So for example, this is a customer who approaches an Islamic bank to seek financing under a Salam structure. So this is a Salam contract which is entered into between the customer and the Islamic bank. And after the execution of the Salam contract, the payment is immediately done by the Islamic bank to the customer. So this is the Salam price which is paid by the Islamic bank to the customer. And in the Salam agreement, it is agreed what kind of commodities will be supplied by the customer to the Islamic bank and what is the time duration for it and what is the place of the delivery. So all the specifications with respect to the goods are agreed upon in the Salam contract and the price is also paid upfront to the customer. Then the customer goes to the market, for example, and purchases that specific kind of commodity from any of the suppliers and delivers that to the Islamic bank. Because the Islamic bank is not in the business of goods, the Islamic bank would again sell it to any of the suppliers in the market and get the cash. So basically, this is the flow of the Salam structure. So this is the Salam contract. This is the immediate spot payment, which includes all the payment of the sale price. This is the delivery of the goods on the agreed date and time and the place. And the goods are same as what has been agreed in the Salam contract. And once the Islamic Bank receives the goods, the Islamic Bank sells the goods to any of the suppliers in the market to get the liquidity back.